Hello everyone, this is Eric. Welcome to my YouTube channel. So today we going to summarize on the book The Psychology of Money Part 2. So let's start. 11. Reasonable irrational. There is a well-documented bias towards the home. People invest in the companies of the country they live in while ignoring the other 95% of the planet. This would not be rational until you consider that in investing you are effectively giving money to strangers. If familiarity helps you make the leap of faith necessary to continue to support these aliens, then the bias towards the home is rational. Day trading and picking independent stocks is not reasonable for most investors. The odds are heavily against your success. But both can be reasonable in small amounts if your other more diversified investments are not affected. 12. Surprise. Scott Sagan, a professor at Stanford University, once said something that should be posted on the wall of everyone who follows markets and investing. Things happen all the time that have never happened before. If you rely too much on investment history, you will miss the very outliers that matter most. History can be a misleading guide to the future of the economy and the stock market because it fails to take into account structural changes that are relevant in the present. The interesting quirk of investment history is that the further back you look, the more likely you are to be looking at a world that no longer applies today. Many investors and economists take comfort in the fact that their forecasts are backed up by decades, even centuries, of data. But as economies evolve, the history of the recent past is often the best guide to the future because it is more likely to contain important conditions that are relevant to the future. The right lesson to draw from surprises is that the world is full of surprises. It is not that we should use past surprises to delineate the boundaries of the future. We simply need to acknowledge past surprises and the fact that we have no idea what might happen next. 13. Possibilities for error. Emotions. Tables can be used to tell you whether the numbers are coming out or not. However, they cannot model well how you will feel when you tuck your children in at night and wonder if the investment decisions you made were mistakes that will harm their future. The difference between what is technically tolerable and what is emotionally possible is an overlooked version of the potential for error. Unexpected risks. You can plan for all risks, except those that seem too crazy to even think about. And these crazy things can hurt you the most because they happen more often than you think and you have no plan for how to handle them. 14. The future you is different than you now. It's a basic tenet of psychology that people are poor predictors of their future selves. Envisioning a goal is easy and fun, becoming a doctor. Competitive activity in support of a goal, combined with the increased stressors of real life, is something else entirely. 12-hour on-call, lost patient. The reason why people like Ronald Read, the wealthy janitor we met earlier in the book, and Warren Buffett have become so successful is because they have been doing the same thing for decades and have let compound interest do the work. But many of us grow so much over a lifetime that we don't want to do the same thing for decades. That said, compound interest works best when you allow years, if not decades, for growth. This is true not only for savings but also for careers and relationships. Persistence is the key. 15. Nothing is free. Everything has a price, and the key to a lot of things with money is just figuring out what that price is and being willing to pay it. The problem is that the price of a lot of things is not obvious until you've experienced them firsthand, when the bill is overdue. 16. You and me. It's hard to understand that other investors have different goals than we do. We are incapable, because of a mental error, of understanding that rational people can see the world through a completely different lens to our own. It is difficult to justify paying $700,000 for a two-bedroom house in Florida in which you plan to raise your children, but it is perfectly logical to buy the same house if you plan to outsell it in a few months in a market with rising prices. What you don't realize is that the traders who set the share price were playing a different game than you. $60 for a share was an acceptable price for the trader because he planned to sell the shares before the end of the day when the price was likely to be higher. But $60 was a disaster for you because you wanted to hold the shares for the long term. The most important thing I can recommend is to do your best to find out what game you're playing. 17. Tempting pessimism. For reasons I've never understood, People like to hear that the world is going to hell. Deirdre McCloskey. 18. Markets are influenced by stories. In 2007, we told a story about the stability of house prices, the prudence of bankers, and the ability of financial markets to accurately price risk. In 2009, we no longer believed that story. Only that has changed. But it changed the world. Once you choose a strategy or a solution, you invest in it financially and mentally. If you want a particular stock to go up tenfold, growth stocks become your tribe. If you think a certain economic policy will cause hyperinflation, that will be your side. 19. To sum it all up. If you want to perform better as an investor, the most effective thing you can do is to increase your time horizon. Time is the most powerful force in investing. Small things grow big and big mistakes fade away with its help. Use the money to take back control of your time. Not having time is a huge and universal blunder against your happiness. The ability to do what you want, when you want, with whom you want, for as long as you want, pays the highest dividend in money. You have to love risk because it pays off over time. But you should be paranoid about destructive risks because it prevents you from taking future risks that will pay off over time. 20. Definition of freedom. Independence, to me, doesn't mean you'll stop working. It means you only do the work you like with people you like at the times you want for as long as you want. Thanks for watching video. Please like and subscribe to our channel.